Cost Accounting, Chapter 16. In Chapter 16, we finish up our bigger chapters about variance analysis. So we've been looking at analysis of direct materials, direct labor, and overhead. In Chapter 16, we switch our focus to look at the sales analysis and why did we have an increase or a decrease in total sales dollars. So we're going to be looking at that sales volume variance and breaking it down into multiple variances. So we're going to look at analysis of sales and productivity. So productivity analysis helps us look at the things that affected our own company's productivity and help us look at strategic measures to improve that productivity and profitability. The key determinants of productivity for most organizations are when we look at the control of waste, product and manufacturing process innovation, and fluctuations in demand due to changes in the business cycle or various other reasons. So when we're looking at elimination of waste, we're looking at things such as continuous improvement, continuous flow, trying to reduce items on our value chain that don't add value from our customer standpoint. And when we're looking at waste, we're looking at what's called lean manufacturing, which is the reduction of waste in the manufacturing line. And waste can be a lot of things. So waste can be things along the value chain. It can be a waste as in like actual scrap or waste, but time waste, materials waste, labor waste, etc. The product and manufacturing process innovation is looking at the competitiveness and understanding that our industry, everything that we do is influenced by the business cycle. So looking to meet demand or slowing growth down if demand is decreased and how that is affected. That also gets into the third thing with that fluctuations in demand. When we are analyzing productivity, productivity is the ratio of output to input. We can look at operational productivity or financial productivity. So operational productivity is physical measures of output, where financial productivity has a financial component to it. So there's a dollar amount that we're measuring. We can also have partial measures of productivity versus total productivity. So total productivity is looking at total inputs and outputs. Partial productivity looks at the relationships between one input factor and the output attained. So different examples could include just the direct materials productivity or the direct labor productivity or the process productivity. Our total productivity includes all of the input resources used in production. Some examples of partial productivity measures. We're going to look at a tool company throughout these examples. So our partial productivity measures are important because any changes in productivity doesn't always occur at the same direction or an equal rate or use resources in the same way. So in this example here, we see that sales increased by 20%, but income increased by only 17%. So did our productivity decline? What can explain that difference in how we can have a 20% increase in sales, but not a 20% increase in operating income? So we're going to look at various productivity measures for this tool company. So we look at direct materials and direct labor, and we're comparing years 2018 to 2019, which is also what we're doing in the previous slide with our sales and operating comparison. So what we see is that productivity did decline for direct materials, but our productivity for direct labor increased. Operational direct labor increased and financial direct labor profitability declined. So what does that say about us? Well, we spent more on direct labor, and it's possible that why we would want to know why we had changes in the productivity labor compared to financially compared to the operational. So when we see the operational productivity in 2019 on the amount of materials and labor used in 2019 relative to the productivity in 2018. So we can break this out even further. So we have our 2019 output of 4,800 units. We have our partial productivity for direct materials and labor, and we look at our output at that productivity level compared to the input. So what we see is a savings or loss in units of input. So we have a savings for direct materials or a loss for direct materials and a savings for direct labor and on that partial productivity. So when we look at the summary for this, our operational productivity measure for direct materials decreased. The partial operational productivity measure for direct labor increased. The financial productivity measures for both direct materials and direct labor decreased. So this suggests that even though our employee productivity per hour increased, the cost increase due to the higher hourly wages more than offset the gain in productivity per hour. So when we're looking at those productivity changes, we have current and prior years that we're comparing for those productivity measures. So in point A is the actual operating results of the current year. And then B is the cost of the actual figures. So we're looking at output and productivity and input cost at the different levels. For points C and D, C is the cost to manufacture the 2019 output at the 2018 productivity level and 2018 input cost. So the difference between B and C is the unit cost of the input resource in each of the 2 years. And point D is the prior period's manufacture. So when we look at these results, we have A, B, C, and D here, which is showing the output productivity and input cost from here. So we have A is the actual 2019 operating results, D, the actual 2018 operating results, and B and C. Then we can show the difference between them. We have the productivity change, the input price change, and the output change. The operational versus financial productivity measures. So the operational uses physical measures. These are unaffected by price change. This also makes them easier to benchmark. So when we're just looking at the productivity as a quantity output or a physical measure output, they're easier to measure and easier to benchmark against each other. When we're looking at our productivity measures, we want to benchmark against our own historical information, and we can benchmark against the productivity of other measures. When we look at the effect of cost, which is of course a major concern for management, we can look at the financial productivity measures. So this is looking at the effect of cost and quantity of an input resource on productivity. It can be used in operations that use more than one production factor. So what we're doing is we're taking the direct materials and the direct labor variances and we're breaking them down into productivity measures and looking at them from a different aspect. There are limitations to partial productivity measures. For example, it only measures the relationship between the input and the output. It doesn't look into any effects that changes in manufacturing have on productivity. It also ignores changes in other prediction factors on productivity, such as an increase in material quality, because we've known that can cause a material cost variance. Other limitations of partial productivity that we fail to include the effects the changes in the operating characteristics have on the productivity of the input resources, such as installing high efficiency equipment. So that goes back also to the previous slide where we have the limitation in not taking into effect anything in the manufacturing, any changes in the manufacturing environment. Improved partial productivity does not mean that the firm or division is operating more efficiently. It just means that they had a partial productivity change. For our total productivity, this is total output for total cost of all input resources used to produce the output. When we're looking at total productivity, this involves multiple steps. So first we want to determine what is the output for each period. Then calculate the total variable costs incurred to produce that output, and then compute total productivity by dividing the amount of output by the total cost of variable input resources. We'll keep looking at that tool company example. So we have our total productivity in units and dollars. So our total units manufactured, the total cost incurred for that manufacture, and then the comparison between the two. We had a productivity increase in the number of units that we produced. Our total productivity in sales dollars also increased. So we look at the total sales to the total variable manufacturing costs incurred when we're looking at total productivity. The benefits and limitations of total productivity measures, that total productivity is measuring the combined productivity of all operating factors. This decreases the possibility of managers manipulating some of those factors to improve productivity measures for others. We're also going to look at different ways that managers can manipulate results in a future chapter. We also have that personnel at the operational level might have difficulty linking the results to day-to-day operations. So we can't really drill down just on our total productivity measures. We need more information, which is why we do some of the partial productivity measures. Changes in total productivity can result from things that are beyond the manager's control. So it could have happened in some of those costs that we don't have control of, such as overhead costs, the variable overhead costs, such as utilities costs. When we're looking at changes in productivity, we need a base year because the basis for assessing changes varies over time. So if we really want good analysis for comparison over a long period of time, we want to have a base year or kind of a standard that we're measuring to. These productivity measures aren't looking at the effect of changes in demand for the product or changes in selling prices. So we are going to be looking at the types of variance analysis that we do that does give us information about changes in selling prices or changes in demand for a product. Because changes in demand alter how much we produce and sell of items. It doesn't necessarily change productivity, though, because productivity is how well we produce output with the number of inputs that we have. But receiving or offering a discount can alter our measures without affecting productivity. So the having a sales price on items can alter that sales total productivity in sales dollars, even if we didn't actually have a change in our physical productivity. So that's another limitation of what that productivity measurement might tell us.